Hi everyone, in this video we will be covering accounting of equity instrument, like how we do accounting when we purchase an equity instrument, that is equity share, any script that you purchase. So how we do that accounting and what IFRS 9 has to say about it. So IFRS 9 says that equity instrument has to be measured at fair value no matter what. In your statement of financial position, that is balance sheet, you need to show it at fair value. And change in fair value from one balance sheet date to another balance sheet date should be reported to P&L, should be taken to P&L. So if you purchase a stock for 100 rupees and the price increase from 100 to 110, so 10 rupees is your profit that you will report in your profit and loss account, and in your balance sheet you will be reflecting the investment or the asset at 110. And if price reduces from 100 to 90, you will be reporting 10 rupee loss for that period and showing your investment at 90 rupees. So that is the basic amount. It's very simple. It's very simple, nothing critical. So but it also gives an option. It also gives an option that, uh, and that is irrevocable option. You can take the change in the value instead of PNL to OCI. Like if it changed from 100 to 110, on balance sheet you will be showing it at 110, but the 10 rupee profit you will not take to profit and loss account. Instead, you will take it to OCI. And similarly, the 10 rupee loss you will not take into profit and loss account, you will take to OCI. And this is irrevocable option. So every year till you recognize this asset, you keep showing it in OCI and will never take this profit to or profit or loss to profit and loss account. It will remain in OCI, and from OCI it will go directly to equity. So I hope this is clear. And what I think why this was given an option, because many organizations make an investment for a very long term period and they don't usually trade in it. See, they say that we don't want to show the stock market volatility in our profit and loss account, as profit and loss account shows our performance, but this is not our performance, this is stock market performance, and these are the long term investment. We don't want to uh, im- uh, uh, don't want to be associated with this stock market performance, should not impact our profit and loss accounts. So let's see how we do the accounting. I hope you are clear with the rules. So the default rule is take the profit to take the changes in fair value to profit and loss account, and there's a irrevocable option where we can change take the profit and loss to OCI. And with regards to dividend, it always has to be taken to profit and loss account only. Okay, see how we do the accounting. So whenever you buy any share, any asset, so what accounting entry will pass? So the accounting entry for you buy any asset is asset account debit, because it increases with that asset, that particular asset, to bank. So when you buy a equity share, that is also an asset. So what accounting entry to pass? So investment in equity share to bank. That is a simple entry that you will pass. And this equity share you will show it at fair value. But in case of bank, especially the investment bank, so they open a particular account for the securities they trade in, and they call it as trading securities account. So they debit that account. So they make a pool, you can say, and all the investment or all the securities they purchase, they keep debiting that account. They keep increasing that asset and crediting. If they're making the payment in the same currency, they can say the cash or bank, but they usually deal in other currencies or not their currency, that not their local currency. So you can say, so they debit the they credit the Nostro account. So what is Nostro account? So that question must come to your mind. So Nostro account is nothing but bank's bank account. So from where bank make all the settlement, usually in foreign currency, is called as Nostro account. So whenever any investment bank make a purchase of a security or stock, so they debit the trading securities account and credit the Nostro account. Let's see an example. With the help of figures, you will get a better idea. So you are a ABC Bank, which is an Indian bank, and they purchase a share of Element Inc., which is a US company, for $10 per share on 10th January 2021. And on the same date, so you purchase around 10 a.m. And when the market closed, the share prices increased to 11. So what accounting entry will you will pass? So whenever, as I just said, so first we see, since it is an equity instrument, so it does not go through the test we have for that instrument, that is the business model test, that which business you are in, if you are in a business to keep the asset and sit on it, or if you buy asset but you may sell it, so don't do that asset, and you don't need to judge whether the cash flows that you will be getting from that asset is a solely payment of principal interest. You don't need to do that. It is a equity instrument. It has to be shown at fair value, and there are two options, either PNL or irrevocable option, that is OCI. Let's assume that it does not choose the irrevocable option of OCI. It chooses a simple option of taking the changes in fair value to profit and loss account. So, what accounting entry that ABC Bank will pass in books of account is they debit an account called trading securities account and credit Nostro. So, the Nostro account is their account they have in US. So, trading security account debit, and the amount is 100K. So one share of $10, and the quantity is 10,000. So 100K debit, 100K credit. I hope it's clear. And when the price increases, so your asset is increasing. So asset is increasing, asset should be debited. So which asset is increasing? Trading security asset. So they will debit trading security account. And what is this? What should you credit? It's your profit. So how is profit? It is unrealized MTM P&L account. So they open an account from which that they take it to profit and loss account. That account name is unrealized P&L. So asset account debit, that is trading security account debit, to unrealized P&L account. Okay. So the 10th, how the 10,000 come? So from 10, it increases to 11. So the profit of 1 rupees for 10,000 shares. So you have, on the day of purchase, you made a profit of 10,000. So when you prepare a balance sheet for that day, for 10th of January, on 10th of January in your balance sheet, you will be showing your asset, that is trading security, at 110K. Okay. So 10, that 100K you bought, 100K you have paid, and the 10K is your profit. So 100 plus 10. This is you paid, and this is your profit. Okay. So by these two entries, I hope it's clear. On the next day, the price increased from 10 to 11. So on 10th January, you're showing it at 110K. So how will you show it in the balance sheet of 11th January? So when the price increased from 11 to 11.5, so when the price increased from 11 to 11.5, so you will show it 115K. So fair value, you have to always show it at fair value. So you have an asset of 110K, so you need to increase your asset. So what account debit will you pass? You will pass trading securities account debit 5K. You already have the asset of 110K, and to unrealized PNL. So you will take more 5K to the PNL. So trading security account debit to unrealized PNL. I hope it's clear. But I tell you one beautiful concept that the most of the banks follow. They don't do the accounting like that. They do a concept called a reverse and refresh. Reverse and refresh accounting. What they do is whatever the asset you have recorded, whatever the changes in fair value you have recorded on the previous day, you will reverse it on the next day and debit the asset showing the net profit you have. Okay, so if you bought it for 100 and the price increased to 110, sorry, so you bought for $10 and the price increased to $11. So on the next day, they will reverse this 10 and show it at 11. So let's see with an example. So on the first day, you booked a profit of 10,000. So they reverse that profit, 10,000. So they reverse that profit and show it as loss and reverse that asset of 10,000 and show a fresh asset. Show fresh asset that the total profit that you have earned on that asset, that is 15K, and credit a net profit of 15K. I hope it's clear. Just have a look. You can pause the video and see the accounting entries. Okay. So this is how we do the accounting of when you purchase a share. So there is a when you bought a share, there is a one more attribute that comes to picture is that is dividend. So you have to record the accounting for dividend. So with dividend there is a term or a date that is associated, that is X date. So what is X date? X date is a date on which if you have the share, so company declare the X date, like on this date, if you have a share, you are entitled to receive the dividend. Even if you sold the share after that date, you will be receiving the dividend. So if you hold a share on that particular date, you will be getting the dividend. I hope it's clear. And usually after the X date, the price of the share is reduced by the same amount, approximately the same amount of the dividend, because it has the price of the share has the value of the dividend itself. So as soon as the date crosses, if you buy the share before the X date, so you will be getting the dividend, and if you buy after the X date, you will not be getting the dividend. So it's obvious that price will decrease after the X date, and it usually decreases approximately by the same amount. But yeah, it's always the market forces that decide the prices. Okay, so on the 30th May, on 30th May, company declared a dividend of $1.5, and X date they say that X date for the record is 10th June, and on 10th June the price was 12 prior to 10th June, and it reduced from 10th to 12 to 10.4. So as I said, approximately same. So it's not has to be 1.5. It's in this case it's 1.6, and dividend paid is on 24th June. So what accounting entry will pass? So on that date, you have the asset of 20,000. That is 12 minus 10. So you purchase a share for $10 and you have it increase the price for 12, so you must be showing your MTM asset, that is trading security, by 2 into 10,000, that is 20,000 on that prior date. But as I said, we do the reverse and refresh accounting. So the profit you are showing for 20,000 you will reverse, so you will show a loss of 20,000 on 10th June, and you will uh, dispose the asset of 20,000 and book a fresh asset of the share. So price is now 10.4. So you bought an asset for 10. Now its price is 10.4. So you will show your asset, that is trading security asset, that is the MTM asset, as at 4,000. So your new asset will be now 4,000, and unrealized profit will be now that you will show in your profit and loss account is 4,000. I hope it's clear. But you have a new asset. So on this date, you are eligible to get the dividend. As you have the share on this date, you will be getting the dividend. So you can show your asset that is dividend receivable account debit, and you will credit an income that is dividend. So you show an asset. So how the balance sheet will look on 10th of June at the close of balance sheet date of 10th June. So your trading securities is now 10.4 into 10,000. It's 10,000. It's 104K. And you have an asset called dividend. Sorry, my pen is not working. So dividend receivable, and the dividend receivable is nothing but 15K. So this is how your balance sheet will look like. Okay. And when you receive this dividend, so as I said, that all the payments and all the receipts are through Nostros. So Nostro account debit, and you will dispose of this asset. You're not longer will be showing this asset. So you'll be crediting the dividend receivable. So Nostro account debit to dividend receivable. So that's how we do the accounting. So these are the accounts we usually prepare. So I've prepared these accounts. You can pause this video and see the ledgers that we prepare. So that's how we do the accounting of shares or stocks. I hope it's quite clear.